Hey, this is Warren Redlich. I'm on a road trip. Plaid Venture resumes. A couple things I want to talk about. First, the short term, what's going on with Tesla's share price and the long-term value of the company. And the second thing, all this talk about Twitter, and there's an article purporting to say that what Elon's legal expenses are. I don't think that's particularly credible, so I want to go through that. Are you ready? Let's go. So we'll see how this goes with filming in the car. It's first time I got a mount. Thank you to Nick for the suggestion of the mount. I'm not using the new mic yet. We'll see if the new mic makes this better. So first thing, yeah, Tesla stock price is down. I think last I saw it was under $240 a share. I happened to buy some more at $246 a share. It's not clear why the stock price is down. There's all this, rumor stuff going on. Deliveries were down a little bit. Production was pretty close to okay. So it's understandable that stock fell a little bit. It seems to have fallen too much. There's all this talk from the short-termers, the Gary Blacks of the world. Oh, there's a Twitter overhang. When the Twitter case gets resolved, the stock will go up. Well, the Twitter case is resolved, the stock didn't go up. S&P 500 or the S&P or Moody's hasn't given Tesla an investment-grade credit rating yet. They got the investment-grade credit rating. The stock didn't go up. The short-term stuff, I just don't play short-term games. I look at long-term value of the company. I can't explain why the markets don't respond well when good news happens, but always respond poorly when arguably bad news happens that isn't even really that bad news. Think about the deliveries were only up, were a miss. It was 40% up year on year, 42% up year on year. That's a pretty good growth rate, and production was up even more. So what is this bad news exactly? This is kind of silly. Meanwhile, FSD Beta is getting me along on Interstate 95. Look at the long-term value of the company. If you Google this, Google forward PE for Tesla TSLA, for Apple AAPL, for Amazon AMZN. What you're going to see, I think the best example of this is Amazon. And I just sold my last Amazon stock and bought Tesla stock with it, so that tells you where I'm going. Amazon's forward price earnings ratio is 50. Tesla's forward price earnings ratio is 40. Tesla is growing faster. Price earnings ratio is supposed to be based on growth. If you're growing faster, you're supposed to have a higher price earnings ratio. Why does Amazon have a higher forward price earnings ratio than Tesla? And I honestly think that Tesla's forward PE ratio is misleading. They're underestimating Tesla's earnings per share for 2023. Even Gary Black thinks earnings per share will be $8 a share. That would mean Tesla's forward PE is really 30. Tesla's forward PE should be at least 50, which would be a share price of $400. And I would argue Tesla's forward PE should be 80, which would be a share price of $640. So you can't control that, but just when you're looking at all this news, it's easy to focus on this short-term stuff that doesn't affect the company. The real question is, are they making cars? Are they producing cars in volume? Are they selling cars? Is car production increasing? Are deliveries increasing? Is revenue increasing? Is profit increasing? All that stuff is growing really well. There's some hints, maybe there are demand issues in China, but they're still backlogged. It's not like they got cars sitting on lots waiting for buyers like other car companies. And I'm not convinced. I just did some reading. I heard somebody saying this, China has demand issues, China has economic problems. You get different stories about China depending on what you're listening to. In the United States, you can't even order a long-range Model 3 because they're so backlogged on the long-range Model 3. There's plenty of demand for Tesla's cars. There's no shortage of demand. This talk, macro talk, whatever. The fundamental thing is that if we are facing an economic crisis, and we very well might be, you want to be in a company that's going to outperform in the crisis. And we've already seen Tesla outperform in a crisis. The strong companies outperform in a crisis. Tesla's a strong company. Tesla makes the best cars. They are the most efficient. They're the most efficient producer of cars. They've got all this great stuff going on. So that's the promising thing. Now, so in short, Tesla's looking great. I actually increased my holding in Tesla rather than decreasing in the middle of all this. They say, this is the time to buy when everybody's freaking out. So the other thing I wanted to talk about was Twitter legal fees. There's this article in Business Insider claiming that Elon's got legal fees of $100 million or $200 million because he's got to pay Twitter's legal fees. Number one, if it's true, if the transaction price is $44 billion and it was $440 million in legal fees, it would still be 1% of the transaction price. So the legal fees would be a small hiccup in this overall transaction. And I read through the article. I don't buy the story that it's $100 million. I'm a retired attorney. I never did this kind of billing, but you know, my napkin math was, you know, the top attorneys are charging $1,000 an hour, the associates are charging $600 an hour. If you added it up and you said, all right, now the article says $2,500 an hour, okay, for the top attorneys. All right, you know, I was sort of questioning, why are you paying that much for lawyers? If you can't get a good lawyer for $1,000 an hour, what are you doing? But, and you know, it's not like the results of this case went particularly well for Elon. If you were spending $2,500 an hour on lawyers and this is the result you got, I don't know. I mean, maybe Elon wasn't listening to their advice in the first place. It seems to me the best, and I don't know what game he was playing, and it may have all made sense. And like I said, you know, even if it is $100 or $200 million, it's a drop in the bucket compared to the transaction cost. Elon's not going to go broke on spending $200 million on lawyers. But my own estimate, if you figure, all right, let's say you had 50 lawyers put in $1,000 an hour for a half a year, that would get you to $50 million. But the case started 3 months ago. Did these lawyers work on nothing else for 3-4 months? The lawsuit was filed in July. So how did you have 50 lawyers working on this case at $1,000 an hour on average? It just doesn't add up to me. I'm not saying it's impossible. I'm just saying, you know, why would you have 50 lawyers working on this case? You know, what were they doing? You know, for 3 months, for 3 solid months, these lawyers are working on no other cases. They're working only on your case. I still don't think you get to 50 million. Now, I didn't work in that area of law. I don't know what's going on. It seems to me this is insane. And you know, if Elon's listening, Elon, I think you can do better. You know, you need better advice on hiring lawyers and spending money on lawyers. And, you know, maybe the right thing would have been having the right advice when you made the offer to Twitter saying, hey, I need these conditions to make sure you guys aren't smoking me on your numbers on bots, right? I need to do some due diligence. And, you know, my guess is Elon had a reason for doing it the way he did it. My guess is also in the long run, this transaction price is going to be trivial. I own Twitter stock. I bought Twitter stock when I heard that Elon was going to buy it. I'm up a little bit. You know, I'm going to make money on this transaction. I'd love to be able to hold stock in Twitter. I don't think that's going to be possible. I think Elon's going to 5x the company in 5 years. I think he understands how to make things more money, and I think he understands how to make Twitter better. So don't spend too much time listening to the hype or the news. Focus on the long-term value of Tesla as a company. This Twitter thing has nothing to do with the long-term value of the company. Whether Elon buys or sells some stock to make the Twitter thing happen has nothing to do with the long-term value of the company. Whether institutional investors who are restricted by investment-grade credit ratings are in the stock or out of the stock doesn't have anything to do with the long-term value of the company. The long-term value of the company is driven by how many cars they can make, how much they can grow their car production and their car deliveries, how much they can grow revenue, how much they can grow profit. And then, you know, can they get robotaxi going? Can they get bot going? Can they get AI training, supercomputers going? If they get all that going, long-term value of the company 2025, 2030 is going to be much higher than what it is now, 10x what it is now. And optimistically 20x or 100x. Let's be optimistic and see where it's going to go. You know, I don't see where else I would put money in this economy. I don't see what other company I would invest in than Tesla. I think Tesla is the best investment right now. That's why I'm in it. Nearly 100% of my assets, other than ownership in a house I can't sell right now. So I'm excited for the future. I hope you're excited for the future. Please check out my other videos. Support me on Locals, Patreon, as a YouTube channel member. Check out the t-shirts. I'm wearing the Be Less Wrong shirt right now at elonbits.com. Please like this video, share it with your friends, subscribe, and thank you so much for watching. Plaid Venture away!